Great Southern Bancorp missed consensus on the top and bottom lines this morning. They reported Q2 2026 net interest income of $49.5 million, which is down about 3% year over year.
Yeah, and earnings per share came in at $1.43, so that missed the street's 1.55 estimate. Overall net income dropped a pretty steep 20% down to $15.8 million.
Right, and the guidance points to completely flat loan growth for the remainder of the year. So naturally, the stock initially took a 3% hit right at the opening bell, but, and here's the interesting part, it actually clawed its way back to flat by noon.
Which is honestly the most telling part of this entire earnings report. I mean, the headline numbers look like a massive miss, but institutional buyers clearly stepped in once they read past the first page.
Exactly, because, when you look at a traditional retail business, seeing overall sales drop 20% in a single quarter means they're having a terrible year. But regional banking is just a completely different animal.
It's an entirely different scorecard. In tech or retail, the revenue line goes down, management panics, right?
Right, they start slashing budgets.
But in this sector, we are looking at a financial optical illusion. A bank can intentionally shrink its own business, print a massive drop in net income, and yet underneath all that red ink, they're actually executing a brilliant strategy to get much stronger.
And that is exactly our mission for you today. Welcome to this deep dive into Great Southern's Q2 earnings. We're going right past that surface-level earnings drop to unpack this massive strategic pivot the bank is executing. They're closing physical locations, repositioning their balance sheet, and basically prioritizing long-term efficiency over short-term size.
It really is a masterclass in capital optimization.
It is. So let's get into the mechanics here. We mentioned the 20% drop in net income and the nearly 3% drop in net interest income, or NII. Now, our research points to a major culprit for this top-line drop, and it involves something called interest rate swaps.
Yes.
But before we throw more numbers around, how exactly does a swap blow a hole in a bank's quarterly earnings?
Well, to understand the drop, you have to look at how banks hedge their bets. An interest rate swap is essentially it's a financial insurance policy against unpredictable interest rates.
Okay, so it's about stability.
Right. A bank might have a lot of loans paying a variable interest rate, meaning their income fluctuates wildly depending on the broader economy. To stabilize that, they will enter a contract with another institution to swap those variable cash flows for a fixed rate.
So they're trading the potential upside of rising rates for the safety of just knowing exactly what they're going to earn every month.
Exactly. But the timeline is what matters here for Great Southern, or GSBC. They had this massive swap in place. And back in March 2020, market conditions moved heavily in their favor.
Oh, like right when rates plummeted.
Exactly. The contract became extremely valuable. So rather than riding it out, management decided to just terminate the swap early. They cashed out the policy and took a huge lump sum payout of about $45.9 million.
That sounds like a massive win. But wait, how does a big win in 2020 hurt their earnings today in 2026?
It comes down to banking accounting rules, specifically this concept called accretion. Even though the bank received that $45.9 million in cash all at once in 2020.
They can't just claim it all as income on one day, right?
Exactly. The rules do not let them. They were required to accrete it, meaning they have to drip feed that money into their earnings slowly over time, spreading it out until the original end date of that swap contract.
Ah, I see. So they were basically supplementing their quarterly earnings with this steady drip of cash from a win they scored years ago.
You got it. But that runway finally ran out in October of 2025. The drip stopped. So when we look at this Q2 2026 report, they are missing about $2.0 million in quarterly interest income that they artificially had in the exact same quarter last year.
Okay, so combine that missing drip with another $1.0 million reduction from two of their current active swaps, and you suddenly have a significant chunk of revenue completely missing from the top line.
Right. The overall revenue pie shrank because the old insurance payout dried up.
But here is the massive plot twist in this report. Despite making less total interest income, their net interest margin, the NM, actually improved.
Yeah, that's the real story here.
It went up to 3.76% this quarter. That's up from 3.68% a year ago and up from 3.71% just last quarter. So they are making less total money, but their profit margin on the money they do make is getting wider.
Right.
It's kind of like a luxury boutique that decides to stop selling clearance rack items. Like, their total revenue goes down because fewer people are walking out with cheap t-shirts, but their profit margin explodes because they're only selling high-end designer bags.
That's a great way to think about it.
But practically speaking, how does management actually pull off a margin expansion while losing top-line income?
It requires a highly disciplined pricing strategy. I mean, a bank's raw material is cash, right? Mostly from deposits, and they have to pay interest to acquire that cash. GSBC looked at their balance sheet and intentionally let their higher-cost wholesale funding just roll off the books.
So they essentially told the market, we don't need this expensive money right now. We are not going to pay premium rates to keep it.
Exactly. They stopped stocking the expensive raw materials, and at the exact same time, they took the cash flows coming in from older, lower-rate fixed loans that borrowers were naturally paying off,
Yeah.
and they redirected that cash.
Into higher yielding loans.
Yes. They deployed it right into higher-yielding residential and commercial real estate loans. They are actively managing the spread between what they pay for money and what they charge for money.
And I saw that the average yield on their loans actually decreased slightly this quarter due to broader market rates.
It did, but they managed to reduce the average rate they paid on their own liabilities even more dramatically. Like, they lowered the rates paid on broker deposits by 61 basis points.
Wait, let me translate for a second. 61 basis points just means they dropped the interest rate they pay by 0.61%?
That is correct. And in the banking world, dropping your funding cost by over 0.5% in a single quarter is an incredibly aggressive, intentional maneuver to protect the margin at the expense of total size.
But I mean, to actually pull off this strategy of making higher margins on a smaller footprint, you have to address the physical overhead. You can't just shrink your loan book and leave all your expensive branches open.
No, you absolutely cannot.
Which brings us to the next massive factor, dragging down their Q2 net income, which is trimming the physical fat. The bank recorded $2.1 million in one-time expenses this quarter.
Right, which completely distorts the net income figure.
Yeah, and our notes show this stems from a major decision to consolidate 9 banking centers across Arkansas, Kansas, Iowa, and Missouri. They are also closing a loan production office in Omaha and eliminating 66 positions.
Those are massive structural changes that completely alter their operational footprint.
Definitely. And when you look at the breakdown of that $2.1 million in costs, it includes $163,000 for a lease termination, $561,000 in severance for those employees, and a massive $1.4 million valuation allowance on 4 of the facilities they actually own and are closing.
Right.
Which means if you exclude these non-recurring one-time costs looking at the non-GAAP numbers, which strips away the accounting noise, their net income was actually a much healthier $17.4 million.
Or 1.57 per share, which actually would have beaten the consensus estimates.
Exactly. And the future payoff for all this pain is that the bank expects these closures to generate $2.3 to $2.7 million in annual pre-tax income improvement starting in Q4 of 2026.
It's a huge operational win.
But wait, I have to push back on the accounting mechanics here for you, the listener, because it sounds crazy on the surface. If they already own these buildings outright, why does it cost them $1.4 million on paper just to lock the front doors?
I know, it sounds counterintuitive, but it highlights a very harsh reality of corporate accounting. The rules require a company to take the pain immediately, but they have to delay the reward.
Walk me through that.
Okay, so when Great Southern decided to close those 9 branches, they were forced to evaluate the carrying value, the book value of those properties on their balance sheet versus what they estimate the actual market value is if they sold them today. Let's say you bought a branch years ago, and it's listed on your books at $2 million. But the current commercial real estate market is soft, and appraisers say it's only worth $1.5 million.
So you have a $500,000 gap.
Right. And accounting rules dictate that the moment you announce you are closing that branch and preparing it for sale, you must immediately record that expected loss. You can't wait until you actually sell the building.
Oh, wow. So they're taking the hit up front before a single building is even sold.
Hence the $1.4 million valuation allowance hitting their Q2 earnings right now. But consider the other side of the ledger. There are 5 other properties they own that are also being closed. Management expects that the eventual aggregate selling price of those 5 properties is going to heavily exceed their combined $12.6 million book value.
Let me guess, they aren't allowed to report that upside yet.
Precisely. They are strictly forbidden from recording those expected gains until the buildings are officially sold and the cash clears.
So the Q2 earnings look artificially terrible because they are forced to show all the potential losses immediately, while the future gains are completely hidden off stage.
That is the accounting reality. Management is deliberately taking a short-term hit to earnings for a long-term operational upgrade, trading a one-time $2.1 million expense today for nearly $2.7 million in pure savings every single year going forward.
That makes perfect sense when you look at it as a multi-year chess move.
Mm.
But, you can't just shutter 9 buildings across 4 states and expect zero collateral damage. When you lock the doors on a local branch, the immediate threat is that the community takes their money down the street to a competitor.
Oh, absolutely. Which leads us to the battle for liquidity.
Right. In Q2, their total deposits decreased by $143.1 million. Dollars. And over the last 6 months, they're down over $180 million. On a surface level, a bank shrinking its deposits sounds like a huge red flag.
In a vacuum, shrinking deposits is the nightmare scenario for any bank executive.
But again, you have to look under the hood. They intentionally shed expensive funding. The report shows brokered deposits dropped over 13%, or $87.8 million. Time deposits, like CDs, dropped 5.4%. I know what a CD is, but what exactly is a brokered deposit? Why are they so eager to dump them?
Brokered deposits are, well, they're essentially wholesale cash. This isn't your neighbor walking into a branch to open a checking account. When a bank needs to raise cash very quickly to fund loans, they can go to third-party financial brokers.
Okay, and these brokers just have cash lying around.
They pool massive amounts of money from investors and offer it to banks, but they demand a premium interest rate in return. It's hot money. It is incredibly easy to acquire, but it is very expensive to keep, and it has zero loyalty to your institution.
So the moment another bank offers a slightly higher rate, that broker moves the money.
Exactly. It's mercenary funding. And Great Southern is purposely letting that expensive money walk out the door.
Got it. But here is the absolute bright spot in the report. Non-interest-bearing checking increased by 4.3%, or $35.9 million.
We absolutely cannot understate the importance of that specific metric.
Because, think about what this means. They are losing total overall deposits, yes. But the ones they are intentionally shedding were costing them a massive premium, while the deposits they are keeping and actually growing are completely free. It's like a consumer paying off $10,000 in high-interest credit card debt and replacing it with a zero-interest loan from a trusted friend. Their total debt went down, but their cost to carry that debt dropped to nothing.
It's a massive win for their margin.
And on top of that, their liquidity remains an absolute fortress. They have $1.23 billion available to borrow at the Federal Home Loan Bank and another $319.6 million sitting at the Fed. But I have to ask about the risk here. With these 9 branches officially closing this fall, what is the real risk of this deposit flight accelerating?
It is a risk management is acutely aware of, and it's a calculated gamble. Remember that projected $2.7 million in annual savings we just discussed?
Yeah.
The bank explicitly noted in their report that customer deposit attrition related to those branch closures is a real possibility. If local business owners and retail customers leave because their convenient local branch closed, the bank will lose those core deposits.
Right, and if they then have to replace those lost funds by going back to the mercenary broker market for higher cost borrowing,
That added interest expense will eat directly into those projected savings.
so the savings could entirely evaporate if the core customers walk out the door in protest.
Exactly. It is the ultimate test of their franchise strength. However, the data we are seeing right now suggests they have a remarkably strong buffer. The fact that they grew core, non-interest-bearing checking by nearly $36 million in a single quarter proves that their underlying franchise relationships are incredibly sticky.
Yeah, people don't just move checking accounts for fun.
Right. Changing payroll, updating auto pays, resetting vendor relationships, it's a hassle. The bank is betting that these core customers stay, even with fewer physical locations, allowing the bank to permanently lower their operating costs.
Okay, so they've secured this cheaper, stickier funding base. Now, what are they doing with that cash when they lend it out to the real world, and what happens when those bets go bad? Because we need to look at their loan book.
The credit quality side of the equation is where the rubber meets the road.
Exactly. Total net loans actually decreased 1.1% to $4.31 billion. The sources attribute this to elevated prepayments, meaning borrowers are paying off their loans early, and an intentional pullback by the bank in commercial real estate and multifamily loans.
Though they did increase construction loans slightly.
They did. But the asset quality here is exceptionally strong overall. Non-performing assets, or NPAs, are a tiny 0.17% of total assets. Annualized net charge-offs are just 0.07%.
Those are incredibly pristine credit metrics for a regional bank trying to navigate this current economic environment.
They really are. And their allowance for credit losses, their rainy day fund for bad loans, is totally stable at 1.46%. But tucked inside this pristine portfolio are two absolutely fascinating problem assets.
Oh, this is the best part of the report.
First, a $1.8 million multifamily apartment complex in eastern Iowa went into foreclosure. The bank took a $909,000 charge-off on it, and now they are spending $800,000 of their own money to repair the property.
Right.
Second, there is a $6.5 million office building in Clayton, Missouri. The bank foreclosed on it, and now they are acting as the developer. They are spending $3 million over several months to install fire suppression sprinklers and make other major improvements to the building.
Yeah, a regional bank acting like a commercial property developer.
It's wild. They're spending $3 million just to put sprinklers in a foreclosed office building. Why on earth would a bank throw good money after bad like this?
Because there's a deeper layer to that strategy, and it is the exact opposite of throwing good money after bad. This is a masterclass in active asset management, and it is a luxury that only a highly capitalized bank can afford.
Walk me through the mechanism of why this makes sense.
Well, consider the alternative. When a typical undercapitalized bank forecloses on a distressed commercial property, their instinct, or honestly their regulators' demand, is to panic.
So they just offload the property in a fire sale.
Exactly. They take a massive, painful loss just to get the toxic asset off their books immediately so they can shore up their balance sheet. But Great Southern Bancorp is not panicking.
Because they brought in independent valuations for that Clayton office building, right?
Yes. And those valuations proved that the local real estate market will pay significantly higher rents and a much higher eventual purchase price for a building that actually has modern fire suppression and updated interior improvements.
So the math actually supports finishing the construction rather than abandoning ship.
Right, but they could only do this because GSBC has robust capital levels. Their tangible common equity ratio is a very strong 11.47%.
Let's define that really quickly. Tangible common equity is essentially the financial bedrock of the bank, right?
Yeah.
The hard cash and easily liquidated assets protecting them from failure, minus the intangible stuff like goodwill.
Precisely. It's their shock absorber. Because they have almost 11.5% in that hard buffer, they have the patience to act rationally.
I see.
They could hold the foreclosed asset on their books, invest the $3 million to fix it up, and maximize their eventual recovery value rather than taking a massive haircut in a desperate fire sale today. It's a testament to the fact that having deep pockets allows a business to make the most profitable long-term decisions.
It's sort of the difference between having to sell your car for scrap metal because you're desperate for $50 today versus having the cash to fix the transmission so you can sell it to a buyer for a proper premium price next month.
That analogy captures the mechanics perfectly.
So bringing this deep dive to a close, let's synthesize all these moving parts for you, the listener. Great Southern Bancorp's Q2 2026 report is fundamentally the story of a bank intentionally shrinking in order to grow stronger.
Right. They are purposefully trading near-term earnings for long-term profitability.
Taking those immediate accounting hits on one-time severance packages, lease terminations, and property valuation allowances. But they have successfully expanded their net interest margin by shedding expensive broker deposits, and they are actively lowering their operational overhead for the future by closing branches.
And despite the scary drop in quarterly headline earnings, their actual book value increased, reaching $58.95 per share.
Yeah, and on top of all that, they are aggressively returning value to you as a stockholder. They repurchased over 114,000 shares of their own stock in Q2 alone, and they paid out a 43-cent dividend.
It is a remarkable case study in choosing underlying franchise value over top-line vanity metrics, which raises a really important question and perhaps a provocative thought for our listeners to take away from this deep dive.
Let's hear it.
If a highly capitalized, fundamentally sound bank like Great Southern is perfectly willing to shrink its balance sheet, shed expensive deposits, and shutter physical branches just to protect its margins of return on equity. Well, what does this signal about the broader regional banking landscape in our current rate environment?
Oh, that's a profound question.
Are we entering a new era of banking where the mantra of smaller but more profitable is going to permanently replace the traditional Wall Street obsession with endless asset growth?
Right.
Because if the smart money is intentionally shrinking their footprint to build a fortress, it forces you to look very critically at the banks out there that are still trying to grow their loan books at all costs. Like, what kind of risks are they taking on just to keep the revenue line moving up?
That is a fantastic point to end on and something every investor needs to be weighing right now. Thank you for joining us on this deep dive into Great Southern Bancorp. Make sure you follow the show for our daily earnings coverage because we are breaking down these reports every single day to help you see what's actually moving the markets. Remember, the next time you see a headline about shrinking assets or falling earnings, don't just look at the line on the graph, look at the machinery underneath. Catch you next time.